Hey, what's going on, everybody? Back in the great outdoors. Today I'm thinking a lot about real estate. Might have seen from my latest post on Instagram and my blog post yesterday that real estate's on my mind right now, which I talked about before because of the stock market's crazy high valuations and multiples. It makes me quite nervous. So I shift my focus towards real estate, which is a hard asset that comes with real income. That usually does well with inflation. So I think a common misconception out there is around how real estate returns work. And people look at it as this sort of fixed income product that suits well to retirees at low yields. But not the case. In fact, some of the most unremarkable real estate these days can earn investors north of 20% per year. So here's how. Real estate's valued based on a cap rate. Cap rate is a percentage that the income before debt service is as a percentage of the value of the property. So if you buy a $100,000 property, that property puts off $5,000 a year in income, 5% cap rate. So when you go and leverage that asset with debt, you go and borrow $80,000, and that $80,000 has a debt service component to it that your $5,000 pays for. Yeah, the cash flow after that is pretty small. But the debt service component includes both principal payments and interest. And with today's interest rates as low as they are, principal repayments are about 8 to 10% return on equity in the first year. So factor that into your returns. In addition, any appreciation of the property goes 100% to the owner, not to the bank. So if your $100,000 property goes up by 5% and you've put $20,000 down as a down payment, that $5,000 in appreciation goes to you. And $5,000 divided by $20,000, that's a pretty damn good return on equity right there from appreciation of 25%. So we're already at 35% return on equity with no cash flow at all. Good luck getting that in the stock market. Furthermore, real estate has tax deductions associated with the value of buildings. So you can depreciate with the IRS or the CRA roughly 3% per year. And that depreciation generally wipes out any taxable income you might have. So in addition to your 25% return on equity, you pay no tax until you sell. So the moral of the story is, when interest rates are low and real estate's cash flowing, buy real estate and hold it forever. And the concept of infinite returns, which I posted about, is when you can refinance your property with the bank after you've raised the income a few times, such that it can service more debt. And that refinance comes with higher bank proceeds to take out your original equity so that you as the equity investor have nothing left in the property. Hence, any return divided by zero is infinite. Pretty magical stuff. See you next time.